Welcome everyone to this episode of Manufacturing Talk Radio. I'm Tim Grady. Lou Weiss is out for today's show. He's on assignment. So we're going to be speaking with Tim Fiore, who is the committee chair for the Institute for Supply Management's Purchasing Managers Index report on business for the manufacturing sector. Tim, thanks for joining us again.
Yeah, thanks for having me, Tim. Good to be here.
So we've got another great report. I was going into the detail of it, which I'll let you share with our listeners and viewers. Looks terrific to me.
Yep, absolutely. Still had a very strong month. Every one of the sub indexes was in positive territory, nothing negative. We had a little bit of sagging on the sub indexes compared to February, but most of them are explainable. Some, are harder to explain. A lot of stuff going on here in Ukraine and Russia. 30% of our general comments noted that as an issue, most of them being more concerned about the future, not so much about the present. But we have had quite a bit of impact from that on the energy markets that seems to have filtered through to everything. It's a global commodity. When global constraints occur, global prices go up. That's what we've seen since the conflict started in late January, and we're over $100 a barrel of oil. We got back below 100, then we went back above it, and now with the SPR release, that should help. But a lot of stuff to talk about here. So, we've had 22 months of growth. As I've mentioned to your readers in the past, we generally average 34 to 36 months on a typical manufacturing expansion. We've had 6 expansions in the last 20 years. My feeling and statements in the past has been that this is going to be a longer expansion because the supply chain has constrained our ability to peak. I still feel that that's the case. We're probably looking at a 42, 44 month. So we might be halfway there, maybe even a little bit less. Since we talked last time, there's been an interest rate hike. So we've had a war, an interest rate hike, and rising commodity prices. What else do we want to deal with?
It's a pretty full house, that's for sure. You and I were talking before the show about the transportation portion of this. And there's just so much going on, Tim. I'm going to let you kind of flow through the report starting at 57.1.
Yeah, so somebody asked me earlier in an interview, they said, so can you sum up the quarter? I said, oh, no kidding. So first we had Omicron, then we had a war, then we had rising commodity prices. Now we've got Omicron B or whatever it is, raging through China, shutting down ports. And that's only in the last 12 weeks. Where do we start?
Right.
Let me, so I have my color slide. You want to put the color slide up and walk the people through the demand, consumption, and input?
Sure, I think that's always helpful.
All right, hold on a second here. Let's see. Okay, you can see that, right? Beautifully. All right, let's pump it up here so it gets full screen. All right, let me get my pointer going. Easier to talk to it. Okay, so as your listeners and watchers know, we have 10 sub-indexes that make up the PMI index, entire index. There's 5 of them that actually go into the PMI index. I group these 10 sub-indexes into demand, consumption or output, and inputs. And I look at the 3, and because they all have their different weightings, and they're all trying to achieve a level of equilibrium, that always fleeting level of equilibrium that's really hard to find. So, right now we've had a demand-driven, supply-constrained expansion, meaning the inputs can't keep up with the demand. The consumption piece in the middle is the conversion element. The reason that we've had input problems is primarily employment. We initially had problems with employment at the panelist companies as well as their suppliers. We continue to have problems at the supplier level. We can talk some more about that. So let's go through the indexes here. One other thing, the manufacturing PMI is made up of the new orders. It's made up of production, employment, supplier deliveries, and inventories. Those 5 sub-indexes go into the manufacturing PMI in equal weightings. So, all right, let's talk about this. New orders came off 7.9. This chart shows you what happened in February. It shows you what happened in March. Remember, generally 50 points and better is expanding, less than 50 is contracting. So the direction here is really above 50, and absolutely the PMI was growing above 50. The rate of change here is slower, which means it slowed down a little bit compared to February. And this is the trend, meaning when it broke 50, how long has it been above 50? Been 22 months. So that's a comment that I made early on. So hey, it all starts with demand. Without demand, you can't convert anything, and suppliers need to do nothing if you don't have the demand. So we've been watching demand very closely. It's been really strong. This is the first month that we've had in the 22 months where this number was probably less than 55, maybe early on, but we haven't seen that number less than 55 in a long time. Down almost 8 points. We'll talk about that in a minute. New export orders, 53.2, down from 57.1, down almost 4 points. Backlog eased off 5. Customer inventories grew 2.3. On the customer inventory number, anything less than 50 is good for the future. This is a reflection really of how much of your customer has of your inventory on their shelves. And when this number is below 50, it means they don't have enough. When it's way below 50, it means they don't really have a lot enough. And when it's above 50, they have more than enough. So this is really good. So what happened here, we had easing on the new order side. There's a couple of reasons for that. One could be that the new export orders backed off. Last month, it contributed significantly to the new order level. This month, it's off 4 points. And you can look at Europe and not be surprised that there's not a lot of orders coming out of Europe right now. Really, really uncertain as to what the future holds there with everything happening in the East. The other piece is that China now has had some pretty consistent rolling city shutdowns, which if cities shut down, there's nobody there to place orders in the US. Therefore, we had a little bit of an easing here. So that's one element of why this new order number came down. The second element is that we've had extremely long lead times for a very long period of time. As you can see here, the prices index went way up on the bottom here. If you're a buyer sitting there with order streams well out in excess of normal order streams, meaning that most order books are already full for 2022 and it's only April 1st, do they really need to go ahead and place orders for well beyond normal lead times at very high prices? The answer is probably not. So they're pausing a little bit. The whole situation in Russia, Ukraine, which made up 30% of the general comments that came in from the panelists, like I said, more about in the future, not about what's happening today, throws a bit of uncertainty into the world economic growth cycle. So a little bit of a pausing, not unexpected. The third thing is that in the month of March, we have a very strong seasonal adjustment factor because March is usually a very strong new order month. But I could easily make the argument that we haven't been in usual periods in about 2 years. So we've been following a pandemic cycle here that is not normal. So you could also argue then that we came off almost 4 points on the raw number here due to the seasonal adjustment factor. We use it every March. It's absolutely applicable, but in these times with extended lead times and things like that, it's interesting. Okay, fine. I'm not overly concerned about it. I think we'll come back up above 55 for sure in the month of April. I think the new export order level will do the same. Backlog is 60. That's a really strong number. 65 is near records. We generally run 55 to 58, so 60 is still really good. The reason this is so high is because we really didn't make a lot of progress on the production side. We'll get to that in a minute. So let's go to the input piece. Supplier deliveries eased a little bit, not much, but they eased. And that's supported by the comments that I received. And we can get into that in a minute. Inventories grew a little bit, which is good. This is manufacturing inventories. The reason this grew is that panelist companies continue to take more raw material and semi-finished goods than they normally would, but they're still waiting for those 1 and 2 pieces so they can ship. As we still do have sporadic shortages. There's a lot of work in process that's now out on the factory floor, waiting for those 1 and 2 pieces to show up. And as we predicted for the last couple of months, this number would grow, and it did. So it's up at a pretty healthy 55.5. We don't normally see manufacturing inventory at that level. So I would expect it could even grow another point and a half. So that helped the PMI because it added 1.9 points to the calculation. Prices, big story here. As we were talking earlier in the show, we had some easing. We had some easing happening, and then we had Omicron hit that caused some problems. We were back on an easing path in February, and now we reversed again and gone up. This is primarily due to energy markets, transportation costs. Steel has reversed its decline, and it grew 25% or so in the month of March. and we have very high aluminum prices, as well as some food products that are now being a big concern because of Ukraine and Russia having a large amount of food exports that feed the international market. So we saw this number come up. Less than 1% of panelist respondents reported a decline in price. So we're back at that really hot level. The situation this time is that when the energy markets shot up, transportation costs shot up with it. People know what's happened to gasoline. The same thing has happened to diesel fuel, and that gets into everything that moves. Those transporters immediately increased their prices, and we saw the price growth hit at all levels of the supply chain. So we'll see what the month of April brings on that. I think we're going to see a little bit of easing. The release of domestic oil here from the Strategic Petroleum Reserve will probably help. That's about 5% of U.S. daily consumption, and it's about 180 days they're planning on. Which, if you ask me, what that means is it's a bridge program to allow the petroleum companies to step up production, where we get back to that 13.5 to 14 million barrels a day of product, which we're not at now because of the last couple of years worth of constraints on investment. Let me put it that way. So the real story here is if labor has been the problem, we're showing definite signs here of improvement. You can see we added 3.4 points, well in excess of prior months' gains. We've been running 0.5 point to 0.75 point for many months here. We had a little bit of a step down there with Omicron, but we got back on track. This is a pretty big step up. For those of you who watch other economic news, you see that the unemployment report was really good. Initial jobless claims is very low. We're definitely getting close to a full employment picture. And our panelists actually supported that with their comments around how difficult it has been to hire. So let's spend a few minutes on this, Tim, because employment has been the root of the problem since we began to come out of the pandemic decline period. And I think it's becoming less of an issue, not only with the panelist companies, but also with their suppliers, which is where the constraints in the supply has been. So I track employment comments every month. I group them into 6 or 7 different categories. We had a hire. One of the categories is hire to force manage. How many companies are hiring versus either managing the headcount through attrition or retirements or layoffs. And we were 15 to 1 in March compared to 15 to 1 in March. In February, 42 to 1. So it was, more respondents said they were hiring, but that had to do with the Omicron issue too. And we had been running 6 to 7 to 1. So we're still a very strong hiring situation. In February, 37% of the respondents said they were having difficulty in hiring. In March, we're at 28%. So an improvement there. One of the reasons that we've had difficulty is the increasing wage rates causing people to quit and move to another employer at a raise. And we have to backfill to account for that. So if you're hiring 2 and you lose 1, you've got to hire 2 again. So we had a backfill rate of 33% in January, a lot of turnover. We're now down to 24% of the comments are about people quitting, which is good. We're making progress, slow but sure. And then in January, we had 11% of the respondents say that people were retiring earlier than anticipated. There was a lot of early retirements there as we closed the year, along with Omicron, and we're now down to 6% of the comments. So total turnover is now at 30% of the comments. It was 44% in January. So things are getting better there. And then I asked the question, is it easier to, I look for the answers around, is it easier to hire people? And in the month of February, 4% said it was. In the month of March, 12% said it was. So, clear signs that the employment side is getting better. I also look in the general comment section for comments around labor. And in January, we peaked at 31% of the comments were labor related, including absenteeism because of COVID and stuff. We're now down to 8%. So not as much of top of mind. And I dig into the supply delivery comments to see how many comments there are around labor too, and that would be primarily their suppliers' labor. And we peaked in January, 16% of the comments were labor related. We're now down to 5. I'm sorry, 25% of the comments in February were labor related. We're now down to 21. So, clear sign, I think, that the labor side is getting better. So the big surprise here was what happened on production. The 4 points off. is it because of demand? I mean, we have the demand there. We have a really healthy backlog. We still have a good level of new orders. We have empty shelves at the customers' facilities. So why didn't this come up? We had a little bit of easing on the supply delivery side. So, I think that the hypothesis here is that, okay, we got a timing issue. We got to do a little bit of adjustment here. More labor's come in. We got more material flowing. Manufacturing inventory is growing. This number should come back. The whole search here has been that number needs to get to 64, 65. And as it should, the demand has been there and the backlog has been there. So one final point here, because this kind of number with a 8-point drop on new orders is going to alarm people. There wasn't a single evidence in the comments that there was any slack in demand compared to prior periods. As I mentioned, we were 6-to-1 positive sentiment about demand versus 12-to-1 in February, but generally for the last 5 months, it's been 6 to 7-to-1. So no one was saying that orders are being canceled. Nobody was concerned about the future, really. It's the demand is still there. So yeah, so the key here now is get the new order level back up in the 58s, which shouldn't be that hard to do, and get this production number up to 62 or so in the short term. Maintain a level of employment growth at, say, a 54, 55. See the supplier delivery number move closer to the lower 60s. Raw material or manufacturing inventory get to 56, and we're in that 57 to 59 range, which I think we're going to be at for quite some time.
Thanks, Tim. What's fascinating to me as we have been watching this over the last many years, but this pandemic period, is that things are good. I would have expected the reverse.
Well, okay, so remember, we had a lot of people stay home and they weren't spending money. They weren't spending money on consumables, on food and entertainment, nothing of hard value. They were putting that money in the bank. I mean, I think the US population saved $1 trillion+. And they've been spending it on, durable goods, on things, renovations of their home, moving into bigger houses, furniture. Furniture was a hot industry sector for us for quite some time, still is. Cars, if they could get a car, they'd buy a car. Toys, RVs, boats, motorcycles. A lot of money spent there. That's all manufactured goods. The issue now is that inflation at the rates that we're talking about is eating up some of that savings. So if you think that Americans saved all this money, and I've always said that even when the service economy opens up, which it is opening up now, there's going to be some period of overlap where people are going to continue to spend money on firm and durable goods. The problem now is the dollar's not going as far. And so if you had $1 trillion a year ago, maybe it's worth 900 billion now. I'm just throwing some numbers out, but that's actually a headwind here to our continued expansion. But I still feel that we're looking at not crossing the 50 line until the end of next year.
Well, excuse me, that's good news, and we appreciate this update, Tim. Another fabulous report, and we encourage people to go to ismworld.org so that you can pull this report down for yourself and really dig into the details and see what your sector is doing. In terms of the sectors, Tim, what's hot and what's not?
Well, so we had a little bit of a shift here. The two biggest industry sectors that drove that the new order number decline were two areas where we have pretty long lead times on average, and that's computer electronics and transportation equipment. Both of them have been running really hot, think high 60s, maybe even mid 70s on one, and they both came off somewhere around 10 to 11 points. So still running in the high 50s level, but not where they were in February. So, you could argue, why is that? Well, it's because lead times are so far pushed out. And so is that really damaging or not? We've had this discussion several times about, are people over ordering? And there's no doubt that people are over ordering. In the computer chip area, component area, you probably would have forecasted 40 to 50% more demand than what you really thought you had done in the last 6 months, just so you get your position in line. The computer and electronic people knew that, and so they were factoring down the forecast. But essentially, we've got, like I said, we've got these long order streams that are well beyond normal lead times. You had rising prices, and people paused. So those are two of the big reasons why we saw the new order level come down, and that obviously contributes a bit to the PMI stepping off too. Production rates in both of those areas were strong. Nothing to be shy about. Think mid-60s on transportation equipment, which is really good. Fundamentally, I think the other one on chemical products of the three that make up almost 40% of manufactured GDP are computers, chemicals, and transportation equipment. And on the chemical product side, you saw strong new order rates, probably driven by the fact that even though we have $5+ per MMBTU cost of natural gas, we're still the lowest priced natural gas area in the world. That level remained pretty high. The level of new export orders was relatively flat, which is surprising because we export chemical products, pharmaceuticals, plastics all over the world. We were flat compared to February. That kind of supports the whole position that the world either had a COVID problem or there's a little bit of concern here about continued expansion in Europe and such. Backlogs are still very good. Customer inventories are still very low. So, fundamentally, we're still in a really good position here, I think, as we go into Q2.
Great. Now, Tim, is there another slide behind this one, or should we just go back to the split screen where we were? And
yeah, I think so. This is this shows the 6 manufacturing expansions in the last 20 years. Expansion 1, expansion 2, 3 post recession, 4, 5, and here we are now. And I think the point on this chart really is that area over 60 right here, and right here, you can see that the expansion that we're in right now spent more time over 60 than any expansion in 20 years. And that's really impressive. And it supports the point that you can't stay over 60 forever. So, the right level for us now is to bounce here 57 to 60. And I think we're there at the low side. I'm a little disappointed this wasn't 58.5 or so. I think the analysts have predicted 58, but I think it's primarily a timing issue. We'll see, this growth get back up in that 58.5 or so for April. Let me see if I can't get this shut down. There we go. Let's see. Okay, is that better? Oh, I got to stop sharing, right?
Yeah, right.
Okay.
Well, I was particularly pleased to see the GDP numbers. I know that in 2020 we were at about 21 trillion. 2021 we dropped to 20 trillion, but in 2022, sorry, I'm a year off. Last year we were at almost 23 trillion. So people are saying, are we yet pre-pandemic? Are we doing as well? Yeah, we are. The United States is in great shape economically at the moment. So these kind of reports and figures are important for people to understand and to listen to this. And Tim, we always appreciate you joining us on Manufacturing Talk Radio.
Yeah, you bet, Tim. I think the biggest headwind here, biggest concern is elevated energy prices for a long period of time. And I think that's the big issue. It affects everything, as I mentioned, even more so than interest rates. I think the quarter point was well within what people expected. People are talking half point maybe. I think this is slow and steady. I think they're expecting to get to 2.5 or something tail end of next year. I don't think that throttles the economy. But I think inflation, nominal inflation here, driven by energy prices, is a concern because you see it everywhere. Like I said, you see it in your gas bill and you see it in transportation, and you got to move everything that's a good, and so it shows up everywhere. If we can do something about the energy costs here, get that price of a barrel of oil back down to 65 to 75, I think that's reinvestment level for the oil companies, and it's good for U.S. manufacturing. And I think that the administration needs to spend a little bit more time on that. This whole thing with releasing 180 million barrels of oil over the next 6 months is a good thing. And like I said, I think it's a bridge to a better solution that's more long term.
Well, we certainly look forward to that. And again, we encourage everyone to go to ismworld.org to get this report. And while you're out surfing the web, please stop by jacketmediaco.com so that you can find our other episodes, including every episode we've done with the ISM since 2013. Tim, thanks for joining us.
Yeah, you bet. Good to be here, Tim. Thanks very much.
And for all of those who are listening and watching, thank you for listening to this episode of Manufacturing Talk Radio. See you next time.